Good morning. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, bringing you the morning comment for the 27th of April. Will the FOMC open the door for June? Today, all eyes will be on the FOMC, which concludes its two-day meeting on monetary policy. The committee is widely expected to remain on hold, with the implied market probability of a rate hike just above zero. Since no press conference is scheduled and we don't receive any updated economic projections, market participants are going to focus on the policy statement and on any changes the committee makes to the outlook for near-term policy. We expect Fed officials to give a hint that they will be carefully evaluating the conditions to hike at one of the next meetings. All Fed speakers we've heard recently, doves and hawks, have noted that the market is too pessimistic with regards to the rate path. Indeed, Fed fund futures are currently pricing that the Fed will remain on hold more or less until the end of the year. While the global outlook has begun to show signs of stabilization in recent weeks, data have disappointed, something that could make it difficult for the committee to compose a more optimistic statement this time. Therefore, we believe that officials may adopt a neutral stance and use this meeting as a stepping stone towards its June gathering. In such an event, we expect the reaction in USD to remain somewhat limited, although the risks to the forecast are tilted to the upside. A change in the statement's language to indicate a more optimistic tone regarding global conditions and the risks they pose to the US economy could reverse some of the greenback's recent losses, though we view this as a low probability scenario. We will maintain the view that the Fed will hit the hike button only once this year, with the most likely candidates being September and December. Elsewhere, a few hours after the FOMC decision, we have two more central bank meetings, the Bank of Japan and the Reserve Bank of New Zealand. The spotlight will most likely be on the Bank of Japan, where we expect officials to introduce further stimulus at this meeting. We believe that the nation's weakening manufacturing outlook, a contraction in Q4 GDP, a flat core CPI in February, and the recent appreciation of the yen are all factors that may push officials to pull the trigger for further stimulus. We expect them to expand the QQE program rather than to cut rates further, especially after the minutes of the latest meeting showed a divided board with regards to the effectiveness of negative rates. This could support Japanese equities and perhaps bring the yen under selling interest. Nevertheless, we believe that any reaction for further easing could be short-lived, as Japanese monetary policy may have started to experience diminishing returns. In New Zealand, the RBNZ meets to decide on its monetary policy as well. Following a rate cut that few market participants, including us, predicted in March, the bank is expected to remain on hold at this meeting. The aforementioned rate cut was the result of very low inflation and a fall in inflation expectations, threatening to become self-fulfilling and lower actual inflation even further. After the latest meeting, data showed that the nation's CPI accelerated in Q1, easing concerns of a potential slip into deflation and taking some pressure off the bank to act again. Additionally, dairy prices rose on average since the previous meeting, amplifying the case for the bank to remain on hold for now. Although the reaction on New Zealand dollar USD is most likely going to be dominated by the FOMC statement's tone, we could see the pair reversing its initial direction or adding it following the statement from the RBNZ. Now, overnight, Aussie USD plunged after Australia's CPI for Q1 slowed, missing expectations of an acceleration. This soft data could increase the pressure on the RBA to act again in the foreseeable future, especially as officials have reiterated multiple times that continued low inflation would provide scope for further easing of policy. We expect the Aussie to remain under selling pressure heading into the RBA policy meeting next week. As for the indicators today, we get the UK preliminary estimate of Q1 GDP, and the forecast is for a slowdown. The forecast is supported by discouraging PMIs throughout the quarter, flat industrial production in January and February, as well as February's employment report, which showed that the number of unemployed people rose for the first time since August 2015. We believe that the uncertainty surrounding the Brexit referendum may have caused firms to delay some of their investment plans, something that could have weighed on growth. Furthermore, in its latest policy meeting minutes, the Bank of England saw signs that demand may have started to be affected as well. Thus, a slowdown in Q1 could ease some of the pound's recent gains. Eurozone's M3 money supply for March is also coming out. From Sweden, we get the Consumer and Manufacturing Confidence Index both for April. In the US, pending home sales for March are due to be released, but this indicator may pass unnoticed ahead of the Fed meeting. We have no speakers scheduled for Wednesday. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade delivered directly to you. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, wishing you solid trading.